What is happening, investors? It is your boy Jack. I am not a financial advisor, and today I'm going to be speaking to you about 10 of my favorite stocks that pay you money. Yes, 10 of my favorite dividend paying companies. There is so much crazy news in the stock market right now, and people are afraid. People are afraid of their profits being ripped away from them just as quickly as they've gained them, and people are afraid of their losses never coming back to where they were. People are afraid to buy stocks because the market is doing so well. I mean, the S&P 500 has had its best ever 50-day rally, and people are afraid to sell because they don't know what's going to happen next. Let's just take a second, guys, to have a look at some of the insanity that is going on in the stock market world right now. The Fed is absolutely pumping money into the market. Airlines. I mean, we all know what is happening with airlines. They have gone from zero to hero very, very quickly. Hotels and casinos. I mean, I made a video about casinos not so long ago when I found out that Vegas was opening back up. And as of right now, MGM has returned over 85% from the lows. I mean, even the casinos are booming, guys. Nikola boomed up over 100%. That is a video for a different day, but that is absolutely crazy and makes next to no sense. And the S&P 500 is not even 5% below its previous all-time highs. I mean, the market is crazy, guys. So when the market is crazy and we are relatively uncertain in what to do, there is always one man we can turn to. And by man, I am referring to 5-year-old pulled over by cops on his way to buy a Lamborghini. This kid was probably invested very heavily in Nikola Motors and American Airlines. So today's video is all about dividend investing and is all about some of my favorite dividend stocks. Dividend investors are in nature long-term investors. And as a long-term investor, you should only be investing money that you can afford to invest. You know, not money that you're going to need next week or in a month's time. It should be money that you don't need right now and you won't need for years or decades to come. And with that thought process in mind, if you're going to continually buy these dividend stocks every week or two, it doesn't matter what happens in the very short term. And the power of dividend investing derives from the power of compounding. Say you put €100 into a company, in a year's time they're going to pay you €5 just for owning that company. You can then reinvest that €5 back in and the cycle continues, and that adds up very quickly. So right before we get into the video, can I ask you to please smash the video a like? The support on the channel has been absolutely insane as of late. I appreciate you all so much. Drop me a comment down below, let me know what your favorite dividend paying companies are, and maybe you know your reason why. And please subscribe if you're new around here. We are on the road to 10,000 beautiful subscribers and we're hoping to get that by next month. So at this rate we have it, but let's just keep the momentum going. Usually with these videos when I speak about dividends, I start with the lowest paying dividend and work our way up. But today I'm going to flip it. We're going to start with the big boys. We're going to start with the highest paying dividend payers on today's list and work our way down. So with all that being said, guys, let's get straight into the juicy stuff. So first up, guys, we have one of my absolute favorite dividend paying companies. We are looking at a company called Altria Group. Now, I have a full video on these guys, so if you want the full analysis, you can go check that video out. But basically, a dividend yield of 7.84%, a dividend safety of 55, so that's borderline safe, and very importantly, an uninterrupted dividend streak and a dividend growth streak of 50 years, making them a dividend king. So generally speaking, when a company has a dividend yield, you know, in the 5, 6, 7+% range, they're usually a little bit more volatile and they're usually a little bit higher risk in nature. And we can see that Altria has been underperforming for the last few years, okay? Literally from those 5-year highs down to where we are now, they're down very close to 45%. Things get interesting, however, when we go over to the max stock chart. I'm going to see that aside from this little dip here over the 3-year time span, there has been some absolutely amazing growth to the upside, and it's very important to keep in mind that these guys have that massive dividend. I mean, this is the kind of growth you expect to see in a growth stock, not a high paying dividend stock. I know a lot of dividend investors like their safer choices, okay, and I wouldn't say this is the safest company in the world. Most of the safest companies in the world probably have a 2 to 3% dividend yield. What needs to be said about these guys, and the reason that I am personally invested in them and I believe in them, is that they're getting into so many emerging markets, okay? So what these guys do as of right now, for their entire history, is sell cigarettes. And for a very long time now, less and less people have been smoking every single year. We can see that in 1954, 45% of Americans said that they had smoked a cigarette in the last week. To 2018, it's only at 16%, and as of right now, it's at about 13.5%. Despite this fact, Altria have managed to be profitable pretty much throughout history. They've always made money, and they've made a lot of money, and their stock price has gone up an awful lot. But now things are to an extent starting to catch up with Altria, and that stock price has started to go lower. So what they have had to do is they've had to branch out. They've had to accept that you can only put the price of a box of cigarettes so high before even less people are going to buy them. So now they're invested in Kronos Group, okay, an emerging global cannabinoid company, in AB InBev, okay, the global beer industry leader. They sell wine, they're in global heated tobacco, okay, IQOS, they're in Juul, the leading e-vapor brand. Now these haven't performed very well, and they're in On, oral nicotine pouches. So if you want more information on why I really do love the look of this company in particular and see it not only as a very high paying dividend stock, but also having the potential to be a growth stock, check out my full video. So on to company number 2. I've already messed up because these guys actually have a higher dividend, but these dividends are changing constantly, okay? But anyway, Enterprise Product Partners LP. EPD is the ticker symbol. I've spoken about these guys quite a bit as well, and I love these guys. So a dividend yield of essentially 8%, okay, a dividend safety of 65, and if we go all the way down here, we see we've an uninterrupted dividend streak of 21 years. Now these guys are a midstream MLP, and essentially they have 50,000 miles of natural gas liquids, crude oil, refined products, and petrochemical pipelines. That's their business. And I mean, we all know what happened in regards to oil prices this year. They went negative for the first time ever, and the recovery looks to be relatively slow. However, there has been a nice recovery so far. As a result, these guys got hit, and they fell as low as 57.5% from peaks to lows, and as of right now, they're only down 23.04%, so they're still a good bit behind the market as a whole, but the recovery has been fantastic. The reason I like the look of these guys right now is because the last time we came out of a really tough time, where oil supply and demand was not in balance, was more than likely the Great Recession, and they had this fantastic rebound, okay? Now, it has been a very shaky last 5 years. Keep in mind they do have that 8% dividend, so it would have offset some of the losses, or it would have potentially left you in a gain depending on where you got in. But it has been shaky, and that's where Pembina Pipeline comes in. If you want somebody a little bit safer, who still has a 6.61% dividend yield, Pembina is the stock for you, okay? Since they've gone IPO, it's been up and up and up. It's been fantastic. Okay? They dropped off here, okay, from 2014 to 2016. In this period of time, there was some politic issues going on in Canada where these guys are based. But since then, you know, coming here, it was up and up and up, and they have just been hit absolutely massively as well, okay? You know, they dropped down close to 70% and still are down 28% with that beautiful history of growth. They've both performed fairly similarly in what they've given back in the last 10 or so years, but EPD, if I could only have one, would be my personal choice. There are an awful lot of companies in the oil industry or industrials, utilities, whatever you want to call it, who do have relatively high dividend yields, okay? So a lot of these companies are always going to be, you know, relatively cyclical in nature. So again, if you're looking for those safer dividends, these may not be the nicest ones for you, and you may prefer to just go with the safer 2, 3, even approaching 4% dividend companies. With that being said, on to number 3. We are having a look at Exxon Mobil, okay? And these guys are actually the third biggest position in my personal portfolio, so that speaks for itself. I most certainly do believe in these guys. A dividend yield of 6.36%, a dividend safety of 55, and if we scroll down, a very nice uninterrupted dividend streak of 37 plus years, and that dividend is being grown at a relatively nice rate. Now I won't repeat everything I just said in regards to oil, because that's going to apply to a few different companies we'll look at today, but Exxon, they're in integrated oil and gas. Upstream accounts for 50% of their earnings. Upstream is things like exploring for, developing and producing oil and gas. Downstream is 28% of their earnings, so that's things like their manufacturing plants, refineries and transportation systems. And then chemicals are 22% of their earnings, so that's manufacturing and marketing petrochemicals and a wide variety of specialty chemical products. Now in regards to Exxon, I do think what makes them so appealing is that nice dividend yield, okay? From highs down to lows, these guys got hit 55%, and again, it's been a very nice recovery, and they're currently still down about 22.8%. This definitely isn't a company that I expect to give me back hundreds and hundreds and hundreds of percent in a matter of a few years. Now, long-term growth, do I see that happening? Yes, I do see some really nice long-term growth in these guys. But with that being said, it could be a very long time. But from a pure dividend point of view, okay, a 6.36% yield. If you're not too worried about the growth, if you're happy with your 10 or so percent every year, which a lot of people are when it comes to their dividend stocks, I think it's an absolutely fantastic pick, and I'm very happy to have them in my portfolio. Now we're having a look at a company called AT&T, okay, a dividend yield of 6.26%, a dividend safety of 65, and we have that uninterrupted dividend streak of 36 plus years. Now again, with these higher paid dividends, they're generally not the safest, and that is definitely true to be said for AT&T. And the way I look at these guys, okay, is I see them as a 6.26% dividend yield company first and foremost, but then I also see them as having a whole lot of long-term potential, and I also see them have been particularly beat up because of some bad things that has happened for these guys recently. I mean, we look at the 5-year chart, and from 2016 to about 2019, the very start of 2019, it was very poor performance. Now, coming from 2019 up until pre-crash, there was some good growth happening again, okay? Nothing absolutely crazy, but growth nonetheless. And then in the last 6 months, they dropped from highs to lows, down about 32%, so not bad whatsoever, and they're currently down about 15%, so again, not bad. Let's just say that over the last few years, AT&T has had a few questionable acquisitions that just have not gone as planned. They've completed an $85 billion acquisition of Time Warner, which did not go well, and they also bought DirecTV 4 years ago for $49 billion, which has gone very poorly. A lot of you probably don't even know who DirecTV is. That speaks for itself. Some of the good though, okay? AT&T is the world's largest telecommunications company. They provide voice services in more than 200 companies, operate more than 34,000 Wi-Fi hotspots, and deliver content to audiences in over 175 countries. 5G is coming out soon, okay? And these guys will look to drive share in wireless by leaning on its recent network investments, its bundling options, and a nationwide 5G service launch. So 5G more than likely will help push AT&T's price back up. So given what's happened the last few years, the last 4 years or so, it hasn't been great, and that has ultimately shoved these guys' price down. But I believe these guys have the potential to most certainly make new highs and continue making new highs for a very, very long time, and that is why they earned a top 10 spot in my portfolio. Oh baby! Wells Fargo and Company. I just bought more of these guys yesterday. I will make a full video at the end of the week letting you know everything I've bought this week, because there has been a few juicy little companies in there. But Wells Fargo, a controversial one. You either love them or you hate them. You love their prospects or you hate their prospects. You're going to think they're going to make you a lot of money or you're going to lose everything. Today we're speaking about the dividend, okay? So 6.12%, a dividend safety of only 40, which is unsafe, and an uninterrupted dividend streak of only 9 years. What I will say is if you're very nervous about these guys, wait and see what Q2 has to say. Wait until the Q2 earnings come out, and I believe that they're going to give us a lot of valuable information. But I mean, we're looking at Wells Fargo, okay? A company who dropped as low as negative close to 60%, is currently down close to 40%, so that means they've rallied up so far very close to 50%. When times get tough, these bank stocks get hit extremely hard, okay? And when times get good, these bank stocks rally extremely hard. And keep in mind, I am looking for long-term investments that I also believe will keep paying me a nice dividend, okay? Look at the end of the Great Recession, right? They dropped from as much as, where are we, around the $34 mark down to that bottom. They dropped 75-ish%, and then the rally, if you got them at the bottom, was beautiful, giving you back over 600% in less than 10 years. I don't think this is one of the companies where the ship has sailed, you know. If you're not in them yet, I don't think it's too late to be in them. If you're not in airlines yet, if you're not in cruise lines yet, if you're not in casinos yet, that ship may have sailed. But something like this, something like your bank stocks, I don't think that ship has sailed. We're getting to the safer dividend companies, I promise you, but the high risk ones had to come first because they always have the highest dividends. In regards to a company like Wells Fargo stock going back up, a massive part of that is, as I just said, the economy reopening will act as a positive catalyst, and I think it will do so very quickly and very aggressively. We look at the PE ratios for some of the other banks, okay? JP Morgan, the only other bank stock that I do indeed own, and the bank stock that I would see as potentially a safer bet, but not a bet that could give you back as much money when things start to go right, okay? They have a PE of 12.7, Wells Fargo have 11.6, they're all in or around the same. It seems to be at a fairly decent price point right now. What's the biggest risk in regards to these companies? If a second wave hits, okay? If a second wave hits, the economy will take a considerable amount longer to recover, and ultimately the banks will suffer absolutely massively. But as soon as these rates start to go down and start to stay down, banks will recover. So we're on to company number 6. The first 5 are out of the way, and those first 5 definitely were the higher risk first 5 of the day. So these next 5, again, they just keep getting safer and safer as the dividend goes lower and lower. So we're still looking at a company that has a 5% dividend yield, which is still a very big dividend yield, okay? We're looking at Chevron Corp, a dividend safety of 65, and where are we? That uninterrupted dividend streak of 33 plus years. And right off the bat, we can see that Chevron expects its dividend to remain safe through at least 2021, even if oil remains weak. So that means that even if the economy, if oil, if everything stays very poor for the next 12 to 18 months, their dividend is safe. Do I expect things to be worse than they are now in 12 to 18 months? Most certainly not, and I don't think that most people do. And 77% of their earnings come from upstream operations. So I said earlier, that's for exploring, producing and transporting oil, natural gas and LNG, liquefied natural gas. So as far as oil related companies go, these guys have a relatively nice balance sheet, okay? Cash, 8.5 billion essentially. Total current assets, 28.5 billion. Total assets, 236 billion. total current liabilities 28.2 billion, so they have the current assets to deal with the current liabilities, and then their total liabilities are only at 91.7 billion compared to the total assets. It's a good balance sheet, especially for the industry, and that is why this is one of the ones who has a safer dividend in my opinion. So a company who's fallen on particularly tough times had, a big hit. They dropped over 55%, and as of right now they're only down 15%, so that's one of the nicest recoveries we've seen from a company who got hit that hard. The best time historically to get into a company like this is when things get tough, when oil gets tough, when supply and demand is all out of whack, and if we did that back at the end of the Great Recession, we would have seen some nice returns. And again, we're speaking about dividend companies. If you have a company who pays you a 3.5 to 4% dividend, in general, you're happy to see about 10% per year, okay? Chevron have outperformed that, and they've outperformed the dividend, returning 5% a year. Another company I own, and another company I'm very confident and happy to own. Woo, we can all take a breath, okay? We're down to a 4.36% dividend yield, a relatively normal dividend yield, okay? And we're looking at Realty Income Corp. They are an REIT, a real estate investment trust. They have a dividend safety of 70 and an uninterrupted dividend streak of 25 plus years. It is not very common to see an REIT get the dividend aristocrat status, so this is very nice to see. So these guys, from highs to lows, went down very close to 50%, and as of right now are still down just over 20%. A quick look at the balance sheet shows us that their total assets are currently close to 18.8 billion, and their total liabilities are only at 8.3 billion. So a very, very good position asset wise. So essentially what these guys do, okay, is they own more than 6,400 properties across America that are leased to about 300 commercial tenants in 50 different industries. So very diversified as one company. So the main worry with a company like this when times get really tough is, will the tenants keep paying their rent, or will they be unable to pay their rent, okay? And we can see that on May the 6th, Realty Income's April rent collection beats peers but is still problematic, okay? They reported that 83% of rent was collected in April, which was better than the industry average. And to me, that number should only go up. More and more stores are opening up across the world and across the US in particular. And simply put, if more companies begin to open up and up, then this stock chart should, in theory, just keep going up and up. So what's very important here is how many different tenants Realty Income do have, okay? Because it makes sense. If a single tenant accounts for a major portion of rent and goes under or decides to walk away after its lease expires, that's going to be very, very bad for the company. So Realty Income's largest tenants by rent are Walgreens at 6.1%, 7-Eleven at 4.8%, Dollar General, FedEx and Dollar Tree, okay? Its three largest industries are convenience stores, drugstores and dollar stores. So no state accounts for more than 11% of total rent. So very, very diversified. If one company gets hit very hard during this virus, it's not going to affect Realty all that much, hopefully. But if you're looking for some diversification in your portfolio and you don't have any REITs in there, I personally think that Realty is a relatively safe bet. The max stock chart is very nice to look at, and we can see that in general it has just been up and up and up. Yeah, it has its dips here and there, it has its bad periods, but ultimately it's been upwards. Okay, now we really are getting to some of the most popular dividend stocks that are out there. We're having a look at 3M, okay? A dividend yield of 3.5%, so pretty much at that threshold an awful lot of long-term dividend investors look for. A dividend safety of 75, and an uninterrupted dividend streak of 62 plus years, guys. 62 plus years. That's a very long time to be paying dividends. Now what I want to speak about, okay, is their 5-year chart, and we can see that from 2018, pretty much at the start, at the very peaks, to where we are now, they're actually down 36-ish%, okay? So they were downtrending before this whole situation began to happen, which is not really what you want to be seeing. They have had a relatively poor performance, and obviously everything that's happening in the world right now would not have helped. These guys have 5 main business segments, okay? Industrial accounts for 35% of sales, healthcare for 19%, safety and graphics 17%, electronics and energy 15%, and consumer products 14%. So obviously, if we have a look at the industrial and electronics and energy segments of 3M's business, they wouldn't have performed very well over the last, few months when all of this began to happen. In the short term, I'm not really sure what I expect to happen from these guys, in all honesty, okay? They're still trading at a PE ratio of 19.4, which is not very good. But from a long-term perspective, a very long-term perspective, I think that this price is going to be fantastic. And I have bought in. I bought in a little bit cheaper, probably around the $150 mark. And if they go down lower again, I would be happy to buy more shares. But again, remember, we're speaking about dividend paying companies, and this is one with a 3.5% dividend who has paid that for over 60 years. From a long-term dividend point of view, it does not get much better than these guys. Next up, we have Sysco Corp, guys. Okay, a company that I don't have anything bad to say about whatsoever. Okay, I absolutely love these guys. A dividend yield of 2.8%, dividend safety of 55, and a dividend king yet again, an uninterrupted dividend streak of 51 plus years, and they've been growing that dividend quickly. I mean, this year, a 14% dividend increase. Last 5 years, 8%. Last 20 years, 11%. It's growing very quickly. So it is only at 2.81% now, but down the line, I could well see a world where Sysco has that 3.5 to 4% dividend yield that so many people look for. Max stock chart, since coming out of the Great Recession, has been absolutely beautiful. We've seen some really nice returns. 5-year stock chart, again, it's just steady to the upside. It is nice returns. It's better than the market average. 6 months, these guys dropped about 63% and are still down about 27%. Oh my days. Balance sheet, okay? Total current assets, 9.85 billion. Total assets, 20.4 billion. Current liabilities, 6.6 billion. And total liabilities, 18.3 billion. So, very good balance sheet. These guys are the largest global distributor of food in the entire world, okay? They act as a middleman between, you getting your food and the people who give you your food. Restaurants account for an awful lot of these guys' sales. Then there's the likes of schools and governments, hotels and travel companies. You get the picture. A lot of these places would have been closed down and not ordering the food that they normally would have been. So people aren't going to these places to buy their food, okay? So obviously these businesses aren't going to be buying the food from Sysco. But as the world starts to open back up, Sysco's going to pick up right where it left off and start selling all of the food again. People are going to need their food. Sysco have to make the list for me. I absolutely love them. I don't see enough people speaking about them. They're one of my favorites. And then lastly, we have J&J. Okay, what is there even to say about these guys that hasn't been said already? Now, dividend yield is only at 2.73%, but the dividend safety is at 99, okay? The dividend streak is at 57 plus years. And again, that dividend is being grown at quite a nice rate. Now, it may take a while before it's 3.5%, 4%, but again, there is a world where that happens. Nothing needs to be said about them. We all know who they are. We all know what they sell. Your Tylenol, your Listerine, your Motrin, your Benadryl, whatever it is. Everybody loves them. They're in pretty much everybody's portfolio. I'll be honest, they only take up a very, very small percentage of my portfolio because I just see them as a really, really defensive investment. But they're in there nonetheless, okay? And that is it. They are the 10 dividend companies we're going to be speaking about today. Some of them higher risk for you high risk lovers, and some of them the safest in the world. So guys, that is it for today's video. For the rest of the week, or at least a few times in the rest of the week, I want to upload some, more in-depth single stock analysis. So if you have any stocks that you would like to see covered, drop them in the comment section below right now. I appreciate you so much for watching the video, especially if you've got here all the way till the end. It genuinely means the world to me. I appreciate you so much. Hopefully you guys did enjoy, and I hope you have an absolutely fantastic day. I will catch you for tomorrow's video. Peace.